Thank you everyone for joining us this morning. I'd like to welcome you all to our first webinar series. So in this series, our team at Lanturn, alongside experts in the industry, will be sharing why your fund or company should be set up in Singapore. So we hope these webinars will give you insight into the current business climate in Singapore. And this morning, we'll be focusing on why Singapore is an ideal place to set up your fund. So all the attendees can ask questions at any point during the webinar through typing in the Q&A chat box. We'll be addressing the questions within the conversation or at the end of the webinar. So firstly, I'm Francesca, I'm the head of sales at Lanturn. I've worked in the corporate services industry for over 6 years, and I'll be hosting the 4 webinars that we're holding over the next 2 days. And without further ado, I'd like to introduce our 3 speakers today. So firstly, Raf is an impact venture investor in early growth stage technology companies. Raf was previously the director for the Asia business of Ventures One, where he had extensive experience in investing in B2B fintech and SaaS companies in Southeast Asia and Europe. Raf also provides entrepreneurship and startup coaching for founders building new companies and looking for their first significant investment. Also joining us is Ian. Ian is an advocate and solicitor with CHP Law LLC. Ian previously worked in the banking industry as a trader in fixed income and derivatives for almost 17 years, including holding managing director roles. His banking career spanned several international banks in Singapore, Hong Kong, and Malaysia before crossing over into the legal industry in 2019 after obtaining his Juris Doctor. Ian graduated with an accounting and finance degree from the London School of Economics and is a chartered financial analyst. Ian merges his finance and legal experience to design new approaches or solutions for clients in fund management and fintech companies. Finally, Chris is the CFO and head of fund services at Lanturn. Chris has 9 years international experience in the financial audit and financial management and has worked in South Africa, the USA, UAE, and Singapore. Prior to joining Lanturn, Chris spent 3 years working at Big Four audit firm, and was later the finance manager for a multinational reseller of petroleum products. Chris has an honours degree in accounting and finance and is a chartered accountant. So thanks to all of the speakers for joining us, and we're looking forward to hearing your insight into these topics. So we're going to start with a broad question first. So what are the key considerations for setting up a fund management company and a fund entity in Singapore?
Thanks, Francesca.
Yes.
Thanks for having us, basically, first of all, and I'm happy to start, I guess, and I would say anything that I share on here is my own opinion and in no way constitutes legal advice. But I guess in setting up any kind of fund, the primary consideration, is probably, well, firstly, your customer. So you're going to want to start in a place or a jurisdiction that your customer acknowledges is good for them. So whoever your investors are going to have to sign off at the end of the day on the jurisdiction. So I think with Singapore, all the work that Singapore's really done to make itself extremely attractive to both fund managers and limited partners or investors into funds is really paying off. And it's been sort of happening over the past actually couple of decades, I guess, but more recently with the incorporation of the BCC, which I'm sure we'll get into. But if we just look at the kind of macro, if you like, the basics, Singapore is kind of a natural hub for Southeast Asia in a way. Over 7,000 multinational companies are set up in Singapore, and 60% of those are HQs for the region or for part of the region. And there's nearly 38,000, I think, at the last count, international companies that aren't large corporates that are still operating out of Singapore as their international hub. So it's got a really great economy, highly competitive. It's second most innovative economy if you believe the Bloomberg report 2021 report index on innovation. Those are some considerations, predictable kind of regulation, I would say, is another one, and I'm sure we can. Another one is tax, of course, tax considerations. So overall, I think it's really become a jurisdiction that is attractive to investors.
Thank you, Raf.
Yeah, so to add on to what Raphael touched on, he did mention some of the key points that usually comes out in the discussions that I have when clients want to set up a fund management company and a fund structure in Singapore. So I like to refer to them as what I call the 4 pillars that are usually discussed. The first one is, of course, the investors. Their profile matters, and Chris mentioned that. Sorry, not Chris, Raphael, sorry, mentioned that the investors need to sign off on the jurisdiction. So that's true. But other than that, we also need to understand their profile because what their residency and nationality is would matter, because there may be tax implications. So that's one part, the investors. Secondly, we also look at the assets that are going to be invested in. The profile of the assets, the type of assets would also help determine the kind of licensing that you may actually require for your fund management company. Other than that, what also this means is you would want to know whether the fund would be closed-ended or open-ended, as well as an idea of the AUM size that your business wants to target. All these would come into consideration ultimately when you are doing your fund structuring. Now, the third one, which is quite important, is the licensing and regulatory framework that is applicable to the fund management company and the fund structure. On this point, I would like to say that whatever I'm sharing is more for your information, and you shouldn't actually rely on it as a legal advice because everyone has their own facts that may be specific to them. And there are also some nuances in how the regulatory framework is applied here in Singapore. So on licensing and regulations, what I'm here to say is that the starting point in Singapore is that if you are conducting a fund management business, you should assume, first of all, that it probably falls under some form of regulations where licensing is required. That's your starting point. But in Singapore, it's a pretty friendly place to conduct businesses. So regulations aside, there are always some exemptions that may be applicable in your situation. And that's something to discuss with your advisors. But generally, I would say that if you are touching on your traditional fund management kind of products, which we call capital markets products, then it's likely that you would be regulated, right? And that also includes trading foreign exchange. There are other categories which are not considered as capital markets products that may actually help you to possibly apply for some exemption. But again, it depends on the very nature of the product itself and as well as the clientele that you're serving. Now, in Singapore, the types of licensing that may be available to fund managers to apply for depends on the scale of your business and who you are serving, the type of investors. So what I consider to be the most stringent would be what you call the licensed fund management company for retail investors. This would mean that likely that you will have to have a certain minimum amount of base capital of at least 500,000. Now, below that, you have a licensed fund management company, but only serving what you call accredited investors. Below that, you have also what you call a venture capital fund management company. What I consider to be one of the lower threshold type of fund management licensing is what you call a registered fund management company. Now, this is just a registration of a fund management. It's not actually a license. And with that actually comes with a lot more restrictions. In particular, your AUM size is limited to 250 million. And the number of investors that you can actually service is only 30. But I also want to stress on the VCFM, or the Venture Capital Fund Management Company licensing. This is something which was introduced I think 3-4 years ago, and it's proven to be quite popular here. First of all, because it's not necessary for the fund manager to be an experienced professional fund manager, unlike the other categories where there's always a requirement number of years that they must have worked as a fund manager or something relevant to that. Whereas for VCFM, what it allows are for entrepreneurs who have substantial industry experience. who feel that they have the ability to identify potential businesses. These individuals have the right experience, and this is something which is the VCFM is catering to. Now, that's generally what I have to say about the types of licensing in Singapore. Last of all is, of course, the tax implications, which Raphael had also mentioned. And this is something which frequently comes up in a lot of the discussions, where the tax that's applicable to the whole consideration here is on the income earned by the fund itself, the income earned by the fund manager itself, as well as the income or distribution to the investors. These are the three parties that needs to be considered in tax structuring, and there are quite a few tax planners out there who are also able to touch on the cross-border issues with regards to your tax investors. So with that, perhaps I hand it back to Francesca before we move into more details in other areas.
Okay, thank you, Ian, for your detailed answer. That's a lot of insight. Thank you for that. Raf, you did mention the topic of tax earlier in terms of choosing Singapore. Could you expand on that a little bit more?
Yeah, so Singapore doesn't have capital gains tax. So I think that's one major consideration for fund managers here. It has fair kind of income tax, 17%, I think. And there's also some exemptions. I think you can, up to the first 10K there's 75% is exempt, and then the following 190K, I think 50% is tax exempt. So there's already kind of a good base there, and then there's no withholding tax on tax dividends in Singapore. Plus, you've got over 80 double taxation, around 80, I think, double taxation agreements. So I'm sure Ian can add more flavor around that. But I would say, yeah, Singapore is an attractive place when it comes to the tax side, definitely.
Yeah, so Raphael did nail it on the point about the double taxation. But especially for the fund structures itself, what's available out there, and I think most people can read about it online. The information is quite widely available. Fund structures that are managed out of Singapore may actually apply for certain tax exemptions. If it's located offshore, then you don't even need to apply, and you may actually qualify under what they used to call 13CA. Now it's been renumbered to 13D. But the tax exemptions are usually applicable only for certain types of designated investments. So your usual traditional instruments like shares, bonds, notes, and derivatives are typically exempted on their income earned by that fund. Other than that, for other fund structures that are located in Singapore, you could actually also apply for the tax exemptions under what you would call 13X and 30R. Previously, this has since been renumbered to 13U and 13O just recently. A bit confusing, but they do it sometimes. So there are, of course, certain conditions to qualify for such tax exemptions, and the tax applications are to be made to the MAS. Typically, the idea is that these conditions are meant for you to support the local businesses in Singapore. That also may mean that you need to hire a minimum number of investment professionals, achieve a certain level of business spending annually. But it's generally not too difficult to meet this threshold from what I've seen. The more challenging one is probably what they call the 13X tax exemption, or sometimes now referred to as the 13U. This particular tax exemption requires a minimum of 50 million in AUM. So what most funds would do, especially if they're startup, you don't start off with 13X or 13U, but you may want to try and apply for what you call 13R first. Or if you are a VCFM and you have some amount of investments that you want to allocate to Singapore startups, you can also consider another provision, which was referred to as 13H. I think now it's called, okay, I can't recall at the top of my head what is it called now, but this is applicable and meant for the venture capital fund managers, where the tax are exempted on the income earned, but I think you have to invest at least 30% of the AUM into a Singapore business. Oh, okay, I think it's called 13G. That's what it's called. And the application is meant to be made to the Enterprise Singapore rather than the MES. Yeah.
Okay.
So these are the tax incentives available for fund income. Fund managers themselves would also be able to apply for some tax incentive. I think there is one for venture capital managers, which is something that Raphael, you could consider at some point as well. This is, I think there's a concessionary tax rate of only 5% for the income earned. That's for income earned as management fees or your performance fees. Again, this is applicable. I mean, you have to apply to the Enterprise Singapore, and there are some minimum conditions to be met.
Yeah. Okay. That's interesting.
Thank you, Ian, for your detail on the tax issues. So maybe moving away from tax and more onto the legal side of fund structures available, do you have any advice when it comes to which structure to choose?
Yeah, so in Singapore, as also similar to other jurisdiction in other offshore jurisdiction, we have your private companies that can be a fund. You can also apply for what you call a limited partnership, or sometimes referred to as the GPLP structures. And in Singapore, you also have unit trusts, but primarily used for retail investments. And lastly, and more recently, as I think Raphael mentioned briefly, the VCC, or the variable capital companies, that was introduced in 2019. So this VCC was more or less modeled after some of the other offshore jurisdiction, where in the Cayman and the BVI, you have something called the segregated portfolio companies. In Guernsey and Jersey, they have what we have cell companies or cell protected companies. So in Singapore, the VCC is modeled along similar lines. There are some differences and nuances, which I'll touch a little bit on. But yeah, so this is what I see to be the trend going forward in Singapore, the VCC structure. Initially, when it was first introduced, I think there were quite a few hesitation among the established fund managers to adopt the structure, but I've seen startup fund managers in particular favoring it over some of the other jurisdiction. Of course, there is a grant that's being offered by MES for applicants who qualify, and there is a co-sharing of costs by MES up to 150,000 or 70% of the cost. This is still available up to, I think, early next year. So time is running out for those who want to apply for the VCC. But the VCC itself, cost aside, I think it's a fantastic structure. Having seen how fund managers have been trying to navigate and to utilize it in a sensible way has been quite interesting. Now, as of the middle of last year, there were about, I think, 300 VCCs that had been set up in Singapore. I believe by now it should be at least 400. And the characteristics of the VCC, just like your other SPCs in Cayman, is that, of course, you can have it as a single fund structure or an umbrella structure, but what is really useful is the sub-funds that you can come under the umbrella structure. So each of these sub-fund primarily means that they have segregated assets and liability. So there's no cross-contagion among the sub-funds. This is similar to the other jurisdiction as well. And what you can think about using these sub-funds are a fund manager, if you are thinking of launching multiple strategies type of fund, this is what your sub-fund can be used. Interestingly as well, each of the sub-fund can also invest in another sub-fund within the same structure. Yeah. Now, that also means that sub-fund could actually be a feeder structure within your umbrella structure. Yeah. And this is where I think the flexibility of using the VCC kind of structure appeals to fund managers who are thinking beyond just offering one single fund strategy. Yeah. Right. Yeah. And you could tailor it to each of the sub-funds to perhaps use for a single geographical kind of investment or certain types of asset class, right? Or even sometimes I've seen some plans to actually use the sub-fund primarily, say, for a family, right? In a way, for for those like multi-family office kind of structures. Yeah.
So each cell could be a different family's wealth under management in a way.
Yeah. So it all depends on how you structure it accordingly, and tax comes in very strongly in this whole structure, because you want to ensure that whatever tax exemption that you apply for that VC structure would have similar strategies in all the sub funds, and that's where you only need to apply one time for the tax incentives that I mentioned earlier, like your 13U or 13O or 13G. You apply it once and it's applicable on all your sub-fund structures.
Yeah, that's. I must admit the VCC is like quite an attractive proposition. Like when I was looking in 2020, I think it was pretty new. And when we were at the time, the company I was with, we were evaluating it as a potential fund structure for us. But when I started discussing with lawyers and corporate services and others, it was clear that I'd be paying a premium basically to help them learn how to do all this new governance and new work. So I actually thought what would happen is that like the big guys would come in and set up their structures, and then everyone would pay the premium, if you like, to the lawyers and the fund accountants, etc., and it would kind of propagate down the food chain. But then I think the complete opposite happened when they created the grant scheme, because then knowing that you can have, I think, up to 70%, at least it used to be, of something like 150k of setup fees, etc., covered as part of the grant, that brought everybody who was waiting or lagging behind or waiting for for it to become more affordable out of the woodwork. And like you say, that it's been amazing how many have been incorporated over just the last year or two. So yeah, that grant scheme, like you say, it's been, I think, one of the key reasons why it's done, why I've seen so many.
Yeah, I think to add on, some of the initial concerns that I used to hear about the VCC and the hesitation around it is, some feel that because it's fairly new, there's been a lack of precedence. But generally, what I've seen is that it's quite it's not that insurmountable to actually adapt some of the GPLP terms into the VCC kind of structure. So an investor that had invested, say, in private equity in a GPLP structure in Cayman, they come and look at the same set of documents from a VCC, particularly their info memo, you'll find that the terms are not too dissimilar. And especially if you are an Asian investor, and personally, I think that most Asians are a lot more familiar with the concept of owning shares in their investment, as opposed to having a share of a limited partnership. And I remember my own self, from my own experience, maybe 10 years ago, when I first started looking at alternative investment companies, and someone showed me, sent to me, the fund manager sent to me the limited partnership agreement, the LPA. And my first reaction was that I thought I'm investing in a share of your investment fund. I don't want to be a partner, but that was when I was much younger. But I think now, in general, Asian investors are probably a lot more familiar with the concept of owning shares in an entity. But probably the most seasoned investors, professional investors that have been exposed to private equity and offshore funds in Cayman, they might be more comfortable with the GPLP structure. But if you look at Singapore, and if you are here in Singapore, chances are you are targeting the Singapore investment community, right? So apart from your sovereign wealth funds or the bigger funds, institutional investors, your newer group of investors are probably coming from the new high net worth bunch of individuals. And with these guys are in their 30s to early 40s, chances are they are a lot more familiar with the concept of owning shares in an entity. And this is where I think the VCC score a plus point. And I do think that it was quite timely that the MAS and the government introduced the VCC framework here in Singapore. At this time, right?
Completely. I think it's almost at the same time as like there's less appeal to the offshore, typical BVI kind of Cayman offshore. The perception of that, I think when Obama, wanted, or like US were looking essentially at, the legality of these different companies. I think that created a bit of a flutter, or people to kind of start evaluating a bit more where the domicile of the fund, like where that kind of Singapore has a lot more credibility than potentially these offshore companies where you have 200 companies in one building. Right? I do think part of that feeling also makes Singapore more attractive, and as Singapore's kind of like, I think I've read somewhere that the least corrupt country in Asia as well, it's got a natural opportunity really with the good regulation and with predictable law and all the benefits that you've been describing. It has a real opportunity to, if you look just at the AUM, it's like an exponential curve since 1990s when Lee Kuan Yew was trying to kind of position Singapore as the hub for international commerce and for fund management, and all right the way up to the present day. Especially with VCC, I think we're going to see such big gains in terms of AUM under management. So I think it's really a force now.
Yeah, you're right, Raleigh. You also nail it on the point about Singapore being the primary good place to actually have the whole structure here, domicile here. But there's also one other thing which I think sometimes people overlook it when they started using offshore structure. The idea of having a VCC here in Singapore also means that your service providers are all in one place. So you don't have to worry about your time zone differences, right? Yeah. If you are working with a service provider in Cayman or BVI, your turnaround times are probably going to be a lot longer. Whereas in Singapore, I think you can call up the person, meet the person within the same day, have things sorted out face to face if you want to. Other than that, you also find that because the ecosystem in Singapore has developed quite substantially over the years, especially Singapore being a wealth hub, you find that the competition among the service providers and the other ancillary services to be quite strong, such that pricing is actually, I am not sure if you experience it, but my impression is that we are quite competitive compared to the other jurisdiction. Right? And coupled with the tax savings that you can still achieve, maybe not as much as the other jurisdiction, I think it all balances out to make us on par, if not even better than the other jurisdiction in certain ways, right?
Yeah, I'd agree. I think it's getting better and better and easier and easier. I mean, maybe we've spoken too long on this question, but I would say it's just the ease of setting up could be something that will improve over time. Like I've seen in Delaware and for VCC, for VC venture capital, kind of setting your first fund up, etc., can be time consuming. But I think that's an innovation that's going to come. So it has to come really. Things like funding the box, etc.
Thank you. Thank you for the detail there, Ian and Raf. I think that's really helpful for our listeners. Just moving on to a couple more questions. So Raf, having managed a fund previously here, is there anything that you would have done differently when setting up now that you have the experience that you have?
I mean, first of all, it was actually a company, it wasn't a fund. So, but we were investigating, as I mentioned, the fund structure. But I think what we found at the time when we were doing that investigation is we had quite a few shareholders, with lots of different interests, and we had a lot of participations because we'd been investing, balance sheet investing off of, essentially into a portfolio of companies in Europe and in Southeast Asia. It almost works against you the more business entities and the more complexity you have. Obviously, of course, for anti-money laundering and KYC purposes, you need to every jurisdiction needs to check every ultimate beneficiary, and if they're overseas as well, they need to have everything in English and notarized, of course. But I think what I would say is it's almost better to start with a blank canvas in terms of the speed of getting approved. And you and I were talking briefly before this call, and he mentioned potentially MAS can ask you to remove some of your board participations or other areas, because it's all about minimizing conflict of interest between you and your fund and making sure there isn't any, in fact, not minimizing, like removing. So yeah, I think I would say for me, it's better to kind of start with a blank canvas, find your partners, go through the process and start something fresh, rather than trying to wrap it into something that you've got many years of background in. But everybody obviously needs to take advice on that from their own professionals and things. But that to me seemed like the optics of it.
Thanks, Raf. Yeah, that's really good to know, and I think that will give some of our listeners something to think about. So it kind of moves on to the next question, which is, do you have any insight onto the biggest challenges for fund managers when interacting with their potential investors?
For me, I think at the end of the day, the investor is the person holding the check. So the power lies with them. So I would say that you need to make sure that you have a proposition that is exciting for them, or that they feel comfortable in the risk reward and they feel comfortable with you. Yeah, the overall thing is that they need to, like, I guess when we're talking about Singapore, they need to feel comfortable with Singapore as the jurisdiction. But I've not really come across, I'm sure, if you've got investors who've been always invested in VCs in BVI or Cayman or whatever, that's very simple for them to get their head around, because they've done it 10 times and they just, okay, yeah, it's a BVI fund. Singapore might take a little bit more explaining, but I don't think it's something that's hard to overcome with some basic facts. So, but at the end of the day, the investor will be the person that decides whether or not they put the money there. But as we mentioned before, there's so much growth in funds here. You can see that investors have zero problems, or most investors have, very little problem with the concept of a Singapore fund.
Mm-hmm. Yeah, definitely. Thank you for that answer. Ian, do you have anything to add on to that?
Yeah, so Raphael mentioned that the investor holds the power, and that's definitely true if you are a startup fund. The competition for new money or seed money or investor money is so fierce out there that some of the investors with even just holding maybe 20-30% of the initial fund size has a lot of say in how you conduct your business. And that also means a bit challenging for the founders, where you are caught in a difficult place, because on the one hand, you need to incur all the costs in getting the right advice, the right structure. But at the same time, you are trying to convince these investors out there to support you when you actually launch your fund. So the time comes when you actually launch your fund and you're not sure whether the investors are there. That becomes a bit challenging, if I'm right, Raphael, right? Because you do not know how much you want to commit. But this is where I think it helps to have a conversation with your service providers, your professionals. They may be able to help you navigate some of the difficulties in how you balance the interest between what you want as a business and as well as what your investors expect. There can be some middle ground, and from there might be some tweaks, but at least you have an idea that should you launch your fund, these investors are probably willing to back you up to a certain extent, rather than you launch your funds not knowing what your investors are even thinking, or even what your investors are looking for.
Yeah,
it's going to be it's like hitting yourself in the face before you even meet a person, right?
Yeah.
So I think having an open conversation and being able to explore what your options are at the initial part helps, right? Then yeah, because you are not actually going to market your funds outright before it's even launched, but you need to have some kind of initial conversations with your investors to know whether or not they are actually going to back you when you actually launch it. Otherwise, it's going to be very stressful for most startup fund managers. You launch your funds and for 3 months, you're just out there meeting people and nobody's committing that check.
Yeah. It's like the Wayne's World, build it and they will come. Well, I don't think
it's
like
not
that.
right. Yeah.
They don't come. So I think, you're spot on with that. The new VCFM fund managers that have successfully raised, I chat a small industry here, chat with them and understand like how they did it, and often they'll have like anchor investors who are in their immediate network who believe in them, or they might have been prolific or good angel investors, and they've agreed to bring some of their own personal investments into the new fund structure, things like this, which are attractive to their friends or their network, etc. So it is kind of, I totally agree. I think for if you think it's hard fundraising for a startup, then startups forget that also VCs are mostly fundraising as much as them. So and certainly for the first fund, I think it's extra hard because you're having to take professional advice from yourself, Ian, and Chris and Lanturn and other people, right? And so it's kind of like trying to make sure that you've got the demand there, I'd imagine, for the fund as you incorporate, rather than setting all this stuff up and then hoping that you will find investors.
Yeah,
it's a big hit to take personally.
Thanks. Thank you both for your answers on that. So I'd like to move on to the topic of fund administration, very necessary part of running a fund. Raf, have you had any previous challenges with fund administration, and how may that influence your choice of fund administrator?
Well, around the time I was looking or shopping around for it, I guess when we were having the VCC early discussions around 2020, etc., I was amazed at, like, I didn't know anything about fund administration, if I'm honest. So when I started asking questions and trying to get pricing on fund administration for a VCC, I was very shocked, I guess, to see the kind of fees involved. And then I started looking into how much work is involved and governance and all these other stuff, and it did feel to me like they were kind of moving the decimal place because it was a fund against my favor, because I think the way that the charging works typically on this kind of AUM, assets under management structure, is fine or acceptable if you have a 50 million or 100 million or 200 million fund, etc. It's kind of predictable, I guess, for the fund manager, and they have enough management fees that it's not really an issue. But I think for emerging funds or first fund, or especially VC funds, which are extremely lean, and as Ian pointed out, you might have 2 full-time fund managers who are angel investors, for example, who've decided they've had good returns and they're moving into fund management. I think the kind of pricing on an AUM basis doesn't make too much sense for them, because the AUM is also very small and there's always like a minimum threshold. So I think what's nice is if you can work with partners, or if you can understand the breakdown of what you're paying for. So this is how much it's going to cost for your licenses, this is how much it's going to cost for your employment passes, this is how much it's going to cost for fund accounting, for this many portfolio companies, etc., then that gives you a lot more predictability in getting the fund going. So you're looking for partners who see the longer term opportunity, because for a VC you don't really make much money for 10 years, and then really it's not fund 1 that makes money anyway. It's fund 2, 3, when you 3x your AUM each time, hopefully, or 4x the amount of assets you have under management. And that's why you see a lot of the local VCs that have kind of done that effectively and now managing hundreds of millions instead of single digit millions that they were in the first fund. So yeah, I do think it's quite an old industry, so there's not many companies disrupting it and using innovation. I think I'm always looking for companies like that, basically, that are adopting innovation and are using things, because you need to have a very lean structure when you start with Fund 1, which is, I guess why I ended up chatting with you guys.
Thanks very much, Raf. As Chris, as our head of fund services, do you have anything to add on here in terms of common pain points that we've seen clients may come to us with previously, or with their previous fund administrator?
Thanks, Francesca. Yeah, so I think on the operational side, the main issues that we've heard about are slow communication times with the fund administrators, and then a lack of access to information. So it maybe takes a week to hear back from your fund administrator, and when you do receive the information, it's sent as a PDF. There's no real explanation of what has been done or any way for you to analyze the data without spending a lot of time yourself. And then again, communication with your investors, who are the people who hold the power and are important to you, is often very difficult and standardized from the fund administrators. Something like a 20-digit alphanumeric password that can't be changed is needed to open the documents. I think that's just a very small issue, but very frustrating for the LPs, who then send a question to the fund managers. And then again, as Raf mentioned, the pricing. So where we're looking at our pricing, we focus on the amount of work that it's going to take, and we're very clear to say, you have this many investors, this many investments, and require us to do quarterly reporting. So that's kind of the matrix we've used to give you your price. Generally ignoring the AUM, because that doesn't impact the work very much, actually. Yeah. And then I think
that makes sense, because you could actually have quite a complex small fund or quite a simple big fund.
Yeah, exactly.
Like if you've got one LP and one investment, it's pretty easy, and I guess it changes over time as well. So like you start off, making deals, and then suddenly, over 2-3 years, you've got 20 portfolio companies, and then you're raising Fund 2, and so you've got, I guess a separate, double the work if you. Over that period, but that's what Singapore wants, isn't it? That's why we're, job creation and helping the economy kind of fire on all cylinders here.
Thanks, Raf, and thank you, Chris, as well. So we are, I've just run out of time, but I do have one final question for the speakers. So looking more towards the future, where do you see the market trends heading in terms of the fund services industry? Ian, if you could perhaps give your insight on that.
Yeah, sure, Francesca. I think for the last few years, we've seen how the equity markets have performed extremely well, say for the last few months. And that has been a major theme for most funds, I think. More of equities and the question of in which geographical countries, regions they want to invest in. But I think what we have also seen in the last 1 to 2 years, there has been particularly an uptick in interest in the alternative types of assets. Here I'm referring to the cryptocurrencies or blockchain kind of investments, sustainable energy kind of teams that creates their own investment ideas there. And as well as other types of non-traditional investments such as NFTs. So potentially, I think we may see a crossover from these alternative types of investments into the traditional fund models, where there may be increasing requests for fund managers to offer such exposure to investors. And I think that's where a challenge lies, in that some of the regulations are not yet prepared to embrace all these types of investments. So we all know how cryptocurrencies and NFTs have been a rage the last few months, but it's not so simple for a traditional fund manager to actually bring in these types of assets within their portfolio for a number of reasons. I think that also means the other service providers like the fund admins, the custodians, the auditors, they need to be comfortable with these assets. And this is where I think you'll probably see a lot more development in the work to be done by all the service providers and the regulators. Other than that, I would just say that I would bet my money that the next big thing would also be things to do with sustainable energy, especially with how we've seen how sensitive, right, oil prices are with any geopolitical risks. I think the attractiveness for this category of investments will only go higher, I think, in time to come.
Completely. I think the whole space, we're 8 years from 2030, which is, quite an important moment in terms of political accountability around climate change. And lots of corporations obviously are wanting to offset more, looking to try and be more sustainable, or coming under increased scrutiny on ESG. So we're bound to see more, I think, investment in that domain. And I also think, to add to that, the big thing I'm seeing in discussions and like looking into personally is around these DAO structures, which is decentralized autonomous organizations. So this is a kind of evolution of blockchain, or the capabilities of blockchain technology, to allow you to kind of create a if you like, a software for your company, rather than have a firm hierarchy. What if you have a crowd, a bit like a mutual or cooperative, where you have hundreds of investors who essentially are managing how money gets deployed into different types of entities. It's a very interesting concept, and I know people who are looking at, like, I think Colorado's has some interesting law where it suits it. So I think there's a few jurisdictions that are starting to think about that, because we're seeing the evolution of companies becoming less hierarchical, or I think because of blockchain, actually, like, there's just opportunities to potentially invest in different ways. But of course, there's always going to be this kind of regulation versus innovation, in a way, that we've seen, with Singapore being very embracing of blockchain companies and tech. It doesn't mean that while they kind of work out what it means in the broader context, and creating sandboxes and having banks and financial services cooperating and creating products with regulation involved from day one, I think is a really good approach. And I hope that they also kind of look at DAOs, because I do see that they're proliferating across certainly across US and other places. And so, yeah, it'd be interesting to see how that kind of evolves, whether it evolves, because it gets complicated once you move off of most things on blockchain stay on between chains and things. Once you come into companies and want to invest from a crypto into company, it suddenly gets very complicated. So I think that's an area that I'm interested in seeing how it evolves, particularly with Singapore's angle.
Thank you, Ian. Thank you, Raf. All right, great. So we've covered all of the topics for today, and yes, just run over 5 minutes. So thank you so much to our speakers, Ian, Raf, Chris as well, for giving your time to discuss with us today. So yes, I hope all of the participants found there was a lot of insight and a lot of useful information. So there will be more webinars that we will be hosting across this week, and also going forward, so in the coming months. And you can stay updated through the Lanturn website, or follow us on our social media pages, LinkedIn or Facebook. And yes, our website address is there as well.
Thanks, guys. Thanks, Ian.
Thank you.
Thanks,
Thanks,
Thanks, Ian. Thanks, Raf.
Thanks, everyone.
Thanks, everyone. Bye.
Bye.